We're going to look at some exemptions and some taxes that may be liable when we look at investment. At death, what you'll find is there will be executor fees. Right? Different jurisdictions will apply different rules, but I'm going to contextualize and give you examples based on South Africa. You can research on the appropriate examples based on your jurisdiction. Make use of ChatGPT, Grok, or DeepSeek. Right. So if I look at South Africa, the executor fees is about 3.5% plus VAT. You can minimize these fees, obviously, by engaging, it could be a family or a friend. However, you need to identify a trustworthy individual. The individual or the family could also still engage the specialist services. It could be an attorney or an accountant where they need them, and this could also potentially reduce the fees that you will be liable to pay. Right. What you need to know is this is based on the gross cost, and the assets that are owned in a trust are not liable for this type of fee. Right. When it comes to estate duty, this is paid by the estate before distribution. Right. So if they are beneficiaries, prior to the distribution of the beneficiaries, that's when estate duty can be paid. If your estate is very complex, you may find that there could be delays in actually the execution of your estate, and potentially this could affect the beneficiaries. However, if we are to assume that everything is handled swiftly, what you'll find is, if I contextualize to South Africa, there is an abatement which you could consider as a discount of 3.5 million. Now, if you've got an estate which is beyond or above this floor, what you're going to find is you'll then be liable to estate duty. And the way it's calculated is, if I contextualize to South Africa, is 20% on the first 30 million, and thereafter 25% on the amount that is above that. You also find that this duty won't affect trust. They continue to retain the assets. There is no estate duty that is going to be kicked in. Then we have capital gains tax, right? At death, it's deemed as an event that could trigger disposal. Of course, there are rollover benefits if the asset is passed to your spouse, or the surviving spouse will be able to take upon this without triggering capital gains case. However, at the death of the surviving spouse, capital gains tax is going to be triggered. So the child or whoever is the beneficiary is going to only inherit after the capital gains tax has been paid. There are exclusions. So there is an exclusion of 2 million for the primary residence, and there is also an annual exclusions or discount, which is 40,000 and 300,000 in the year of death. Now, what it tells you is, if your primary residence is worth more than 2 million, right? If you are married in community of property, if it's worth more than 4 million, it means the value above that will be liable for capital gains tax. Right. So if you, for example, were to retain this property in a trust, you will not necessarily need to trigger this capital gains tax. And then there is also some exemption for interest that is available for an individual. So if it's an individual, if you're under 65 in South Africa, you're looking at about 23.8. But if you're over, you're looking at about 34.5K. So what it also tells you is the taxation that will get applied for earnings from interest will be less for an individual. These exemptions may not be available for other vehicles such as companies and a trust. So when you are doing your projections, trying to identify the appropriate vehicle, look at these factors. Of course, the rental income, which we have talked about, is going to form part of your income, and you to be taxed based on, if it's in your individual capacity, the taxation that is currently being applied. If it's a company, it's normally a non-static figure, and if it's a trust, it's also the same. So choosing the appropriate vehicle requires you to assess your wealth floor. What is the wealth floor? The wealth floor is the minimum value of wealth you aspire to acquire. If it's below, for example, the exclusions that you have in capital gains tax, or below the exclusions or the abatement that you have in terms of estate duty, it may be very straightforward to just own the property in your individual capacity. However, if it's going to be above, you are likely going to pay significant fees, and these significant fees would deplete your wealth at death. So choose wisely. All right. What's just being displayed on the screen is just the formula for capital gain. So this is the market value minus the base cost. So the base cost takes into consideration costs that you would have done to improve. Of course, that means you need to have good accounting so that you may be able to present these costs. And then the taxable gain is actually calculated by the capital gain multiplied by the inclusion rate. If I contextualize to South Africa, it's 40% for individuals, 80% for trusts and companies. Then what you then find is the capital gains tax will be the taxable gain, right, after factoring the inclusion rate times the marginal tax rate, which will be anything between 18 to 45% for individuals, 27% for companies, 36% for trusts, unless, of course, it's distributed. There is also a primary residence exclusion that's up to 2 million of the gain. So this formula can help you to calculate. Again, if you're in a different jurisdiction, please just get the appropriate formula, or better still, just leverage on AI to help you. ChatGPT, Grok, or DeepSeek can actually do that. When it comes to estate duty, what you'll find is it's levied on at 20% on the first 30 million, if I'm contextualizing to here in South Africa. However, there's a 3.5 million abatement, and this is also rolled over to a spouse, right? So if you owned your estate jointly with your spouse, you'll be able to also roll over, and at the point of death of the surviving spouse, they'll get double the abatement available for them. No tax is paid by the beneficiaries, so it's actually paid in the estate of the deceased. So estate duty, for example, will be 20% multiplied by the dutiable estate if it's less than 30 million, plus 25% multiplied by the dutiable estate if it's greater than 30 million. So whatever value is greater than 30 million will then be taxed at 25%. However, you are likely to trigger executor fees. The maximum will be 3.5% times the gross estate value plus VAT, which is 15%. So the capital gains tax will probably also be triggered at death, right? If it's not death of the first spouse, definitely at death of the second spouse as they leave the inheritance. So death is also deemed as a disposal event, right? Now, the capital gains tax will be calculated based on the market value and only the proceeds after payment of this tax. Imagine if you don't have the cash or the funds to pay for this tax. What it also means is your assets could end up being disposed in order to service this cost. So you need to have, if you're owning your assets in your individual asset, you need to ensure you plan for this. Get insurance, right? And or get or ensure that you have a cash payout that is going to be available to service this cost. There are benefits, or there's a rollover that can be applied to the surviving spouse, and this will allow no tax to be paid until the surviving spouse passes on. Right. So for trust, capital gains tax will probably only apply if the assets are distributed or if there is a sale of the assets. However, if they are kept within the trust, no capital gains tax. And then there's also an exclusion of 40K if I contextualize to South Africa, and 300,000 for the year of death. Now, all these will will be factored in the dutiable estate. Stay connected. Follow us on social media via the handle @NuggetsAbode. The latest investment nuggets and many more. Don't miss out. Subscribe now and be the first to know what's new. visit us at marketsabode.com.